Something truly extraordinary is unfolding in the silver market right now, and if you're not paying close attention, you may be overlooking one of the most significant wealth-building opportunities of this entire decade. A legendary market veteran with more than 40 years of experience has just issued a forecast so bold that it is sending shockwaves through the global investment community. Michael Oliver, the momentum and structural analyst who accurately warned of the 1987 stock market crash, now believes that silver is finally breaking free from a price ceiling that has suppressed it for more than 50 years. At this very moment, as I'm speaking to you, silver is trading near $88.84 per ounce. That implies a potential return of approximately 2.3 to 5.7 times your investment in just 4 to 6 months. But what makes this moment fundamentally different from typical market hype is this. This is not about speculation, hype cycles, or get-rich-quick schemes. This is about a deep structural transformation in the silver market driven by forces that have been building quietly for decades. In the next few minutes, I'm going to show you exactly what is happening beneath the surface of the silver market, why multiple analysts believe we are witnessing a historic repricing event, and what it means for anyone looking to protect and grow their wealth in an increasingly unstable financial world. To understand why this moment is unlike anything we've seen before, we need to look back. For the past 5 decades, silver has been trapped. While other commodities, such as copper, lead, and even gold, have broken out and established entirely new price regimes, silver remained locked inside a long-term consolidation pattern. Think of it as a pressure cooker. For 50 years, powerful fundamental forces have been building pressure beneath the surface while the price lid remained firmly sealed. According to technical analysts, that lid has now blown off. Michael Oliver describes the current phase as silver entering a completely new reality. This is not a temporary rally that fades back into old trading ranges. This is a structural transformation of the market itself, and the evidence is visible in the way silver is now behaving. In traditional silver bull markets, prices would rise, then correct for several months, then climb again in a predictable stair-step pattern. That pattern no longer exists. Recent corrections in silver have lasted only days instead of months. When silver recently declined by 16% from its highs, the entire drop was erased in just 10 trading sessions. This behavior tells us something crucial about who is buying and why they are buying. These are not short-term traders flipping positions. These are industrial manufacturers that require physical silver for production. These are sovereign wealth funds building strategic reserves. These buyers view price dips as opportunities, not warning signals. As a result, the market is forming what analysts call a rising support floor. Each correction establishes a higher low than the previous one. At present, that support level sits firmly around $60 per ounce, meaning any sharp declines toward that level are immediately absorbed by aggressive buying. To understand where silver is ultimately headed, we must examine the 4 powerful forces converging right now. Here is a fact that should alarm anyone paying attention. For at least 5 consecutive years, the world has consumed more silver than it has produced. We are running a structural supply deficit of roughly 200 million ounces every single year. And this gap is widening, not narrowing. There are 2 primary reasons for this. First, industrial demand is exploding across sectors where silver is completely irreplaceable. Solar panel manufacturing relies on silver's unmatched conductive properties. With China producing between 80 and 90% of the world's solar panels, this single industry is consuming massive quantities of silver. Artificial intelligence is fueling the construction of enormous data centers, all of which require complex electrical infrastructure where silver plays a vital role. The AI revolution is not slowing, it is accelerating. Electric vehicles use substantially more silver than traditional internal combustion vehicles. As transportation continues to electrify worldwide, silver demand from the automotive sector keeps climbing. Advanced electronics, from smartphones to medical equipment, also depend on silver. This is not discretionary demand that disappears during recessions. This is structural, non-cyclical demand. The second factor is supply. Mining cannot respond quickly. You cannot simply turn on new production. Discovering deposits, securing permits, raising capital, and bringing a mine into operation takes a decade or longer. Years of suppressed silver prices discourage the massive investment required for new mines. The existing operations are exhausting their highest grade ore, and recycling, while helpful, cannot close the growing gap. Michael Oliver explains that when markets ignore structural supply deficits for extended periods, price corrections do not occur gradually. Instead, they happen violently and rapidly, forcing prices to jump to levels they should have reached years earlier. He refers to this as lightning-style repricing, where decades of pressure are released in a compressed time frame. For those new to precious metals, the gold-to-silver ratio is a simple yet powerful tool. It measures how many ounces of silver are required to purchase 1 ounce of gold. With gold trading near $4,620 and silver around $88, the ratio currently sits close to 52.1. Historically, the long-term average is near 50.1. But during precious metals, bull markets, the ratio collapses, sometimes falling to 31 or even 20:1. This matters because silver is a much smaller market than gold. When capital flows into precious metals, silver must move far more dramatically to absorb that demand. According to Oliver's analysis, a critical 10-year ceiling in silver's performance relative to gold has now been broken. The same technical pattern appeared before the explosive silver moves of 1979-1980, and again in 2010-2011. In 1979, silver rose more than 4.5 times in just 5 months. In 2010, it more than doubled in roughly 7 months. This time, Oliver notes the base is even wider, suggesting an even larger potential move. If gold were to reach $8,500, matching its historical 8-fold bull market performance, and the ratio dropped to 21, silver would trade near $425 per ounce. Even under conservative assumptions, gold at $5,000 and a 30.1 ratio, silver would reach 166. These are not fantasies. They are mathematical outcomes grounded in historical precedent. Unlike traditional chart watchers, Oliver's proprietary methodology focuses on momentum structural analysis. He compares price charts to a speedometer. They show speed but reveal nothing about engine power. Momentum reveals the force driving the move. In July 2020, silver's momentum indicators broke through levels unseen in decades, even while prices were still in the $20 range. Since then, every indicator has confirmed strengthening momentum. The internal structure of the market has fundamentally changed. During the 1979-1980 silver surge, traditional indicators such as RSI remained overbought for more than 12 consecutive months. Investors who sold early missed the majority of the move. Oliver's warning is clear. Traditional technical rules do not apply during structural market transformations. Momentum suggests silver is still in the early acceleration phase, not near a peak. When true parabolic behavior appears, signaling exhaustion, Oliver will recognize it. We are not there yet. And beyond industrial fundamentals, there's a powerful monetary force unfolding. Major economies, including the United States, Japan, and the United Kingdom, are facing unsustainable debt burdens. This is not opinion. It is mathematical reality reflected in debt to GDP ratios. When bond markets destabilize, central banks face a choice: allow yields to explode and trigger economic collapse, or intervene directly by purchasing bonds. And they are choosing intervention. And intervention means creating massive amounts of new currency. Analysts call this fiat currency debasement. When central banks print unlimited currency to purchase government debt, the value of each unit declines. In such an environment, investors naturally seek assets outside the debt-based financial system. Physical gold and silver, with thousands of years of monetary history, become safe harbors. We are already witnessing this dynamic in action. Central banks across the globe are accumulating gold at record levels. Sovereign wealth funds are building strategic precious metals reserves. This represents a fundamental vote of no confidence in the current monetary system. When these capital flows accelerate, they generate enormous upward pressure on gold and silver prices. Meanwhile, stock markets are showing dangerous fragility. Michael Oliver describes equities as dancing on glass, with long-term momentum indicators at critical inflection points. He warns of a potential 50% decline in the S&P 500, not a minor correction, but a devastating crash. When this occurs, capital will flee traditional financial assets and rush into tangible stores of value. Gold, silver, and other commodities will be the primary beneficiaries. History confirms this pattern. In the 1970s, stock markets stagnated for a decade, while gold surged from $35 to $850, and silver jumped from $1.50 to $50. Oliver believes we are entering a similar commodity supercycle, amplified by factors that didn't exist 50 years ago. Industrial demand drivers like solar, electric vehicles, and AI infrastructure simply weren't present in the 1970s. Recent weeks provide concrete evidence of these dynamics. COMEX reported that silver delivery notices in January are already 3 times higher than the entire month of January last year, signaling intense demand for physical metal, not just paper contracts. The exchange has introduced a new 100-ounce silver futures contract to meet what it describes as record retail demand. Margin requirements have increased and shifted from fixed dollar amounts to 9% of notional value, preparing for higher prices and volatility. In China, the Shanghai Futures Exchange saw silver prices reportedly touch $100 per ounce, indicating significant premiums over Western markets. The United States Mint announced a 1-month delay on 2026 American Silver Eagle coins. When released, they sold out immediately. Retail dealers like APMEX briefly saw bulk silver Eagle prices reach $99.69 per coin, nearly $12 above spot. Most tellingly, the U.S. Treasury Secretary convened a ministerial meeting focused on securing critical mineral supply chains, including silver. This is high-level government recognition of a strategic resource problem. These are not abstract predictions. They are real market events happening now. While physical silver offers substantial upside, mining companies present even greater profit leverage. Consider the math. A miner producing silver at $20 per ounce, selling at $30, earns $10 profit per ounce. If silver rises to $100, profits jump to $80 per ounce, an eightfold increase. Mining stock prices often move 3 to 5 times the underlying profit increase, meaning share prices could rise 40 times. History confirms this. During the uranium boom, uranium prices rose 7-fold, while the best junior uranium miners gained 50-fold. In the lithium surge, lithium prices increased 13 times, with top miners climbing 100-fold. Michael Oliver emphasizes junior miners as the greatest opportunity, especially where the highest returns lie. Selectivity is critical. Some mining companies hedge production, limiting upside. Others operate in politically unstable regions or have weak management. The most attractive investments are unhedged producers in stable countries, Canada, the US, and Australia, with competent teams and high-quality assets. These represent high-risk, high-reward opportunities, suitable only for aggressive portfolio allocations. Before investing in silver, a critical reality must be understood. This market will be violently volatile. Legendary resource investor Rick Rule reminds us that even during the 1970s gold bull market, prices fell 50% mid-run. Investors who panicked missed the subsequent surge from $100 to $850, an eightfold gain over 6 years. Rule asserts that silver will experience a 25-30% correction during this bull market. These corrections are purposeful, shaking out weak hands and creating accumulation opportunities for strong investors. Recent history illustrates this pattern. Silver recently fell 16% from record highs, but fully recovered within 10 trading sessions. Panic sellers locked in losses. Those who held or bought dips were rewarded. Silver is not for day traders or short-term capital. This is for investors with a 4 to 6 month horizon who can tolerate interim volatility. If you check prices daily and panic at red numbers, this is not the market for you. The key is perspective. Corrections are normal features of major bull markets, not signals of failure. Investors who maintain conviction during drops stand to reap substantial rewards. Oliver and other analysts offer a strategic framework rather than specific advice. For those without silver exposure, building a position through dollar cost averaging over 30 to 60 days reduces the risk of entering at a temporary peak. Physical silver, coins, or bars provides direct exposure without counterparty risk. For aggressive investors, carefully selected mining companies offer leveraged exposure. Focus on unhedged producers in politically stable countries with strong balance sheets. Junior miners offer the highest potential returns, but also the highest risk. A 50% interim decline should be expected. Only allocate capital you can afford to see fluctuate dramatically. Finally, establish a clear time frame. If targeting the second quarter of 2026, as Oliver suggests, corrections in February or March are noise. Your focus is on April, May, and June prices. Have an exit strategy. Oliver's 40 years of market experience allow him to identify momentum peaks. When he signals breakdown, that's the time to take profits. The goal is capturing most of the trend while avoiding the crash that follows mania phases. Looking at commodity history, a consistent pattern emerges. When a commodity trades in a range for decades, pressure builds below the surface. Supply and demand fundamentals evolve, but prices remain constrained. Eventually, resistance breaks, and the move is explosive and compressed in time. Copper, for example, traded between $60 and $120 for 20 years before breaking out. When copper broke out in 2003, it climbed to $4.50 by 2011. Early buyers earned 7 times their money. Lead traded around 50 cents per pound for 30 years before surging to 1.75 within 18 months in 2007, a 3.5x move. Michael Oliver's momentum system identified both breakouts early, allowing his clients to capture the majority of those gains. Now, he says the same technical setup exists in silver, but with even stronger fundamental drivers. The supply deficit is far more severe than it was for copper or lead. Industrial demand growth is faster. The monetary crisis is more extreme. That's why his targets, $200 minimum, $500 in a potential mania phase, may seem aggressive. These aren't arbitrary numbers. They are based on historical precedent combined with current technical readings. Notice that mainstream financial media is largely ignoring the story or dismissing it. Silver is already too high, they say. It's overbought. A bubble is forming. That skepticism is actually bullish. Major bull markets rarely begin with CNBC breathlessly reporting the trend or neighbors asking how to buy. They start quietly, with professional investors accumulating while the public remains unaware. The mania phase, when silver dominates evening news headlines, coin shops have lines, and even your Uber driver asks about it, comes much later. Right now, retail investors are mostly asleep, while institutional money positions quietly. Michael Oliver calls this early stage acceleration what he terms leg 2. The base is built, the breakout confirmed, and the powerful upward move is underway. By the time mainstream attention arrives, silver could already be $150 or higher. The easy gains may already be captured. That's why Oliver's message, "It's not too late," is critical. Technically, the move is just beginning, but the window before the crowd arrives is limited. We're at a unique moment in market history. Multiple forces converge on a single commodity that has been fundamentally mispriced for 5 decades. A structural supply deficit that cannot be quickly resolved. Industrial demand drivers accelerating, not slowing. Technical breakouts that historically precede explosive price moves. A global monetary crisis pushing capital into hard assets. Michael Oliver, who has navigated 4 decades of commodity cycles, correctly predicted the 1987 crash and identified major breakouts in copper and lead, states with conviction that silver is entering a new price reality. His minimum target, $200 per ounce by Q2 2026, 6 months from now. In a mania scenario, his potential target approaches $500 from current levels around 80 ores, representing 2.3x to 5.7x potential returns. The choice is yours. You can dismiss this as hype, like mainstream media often does. You can tell yourself you've already missed it because silver has risen, or you can objectively examine the evidence, the supply deficit, technical breakout patterns, monetary pressures, and the track record of the analyst issuing these projections. Then make an informed decision about whether silver belongs in your portfolio. This isn't about investing your entire net worth in a single commodity. It's about recognizing when market fundamentals create asymmetric risk-reward opportunities. From $88, downside is limited and likely temporary. Supported, technically at $60. Upside to $200 or beyond represents potentially life-changing gains. Time is critical. If Oliver S. timeline holds, and his 40-year track record suggests it should, you have 4 or 6 months to act and build a position. A note of caution. Nothing here is financial advice. This is analysis from market professionals with proven track records. The decision is yours. Do your research, understand your risk tolerance, and never invest money you can't afford to lose. Never invest in something you don't even understand, but also don't tease, ignore opportunities out of fear or conventional wisdom. Michael Oliver's core message is simple. Silver has broken out of a 50-year ceiling. Market structure has fundamentally changed. Buyers are different. Momentum is unprecedented. Fundamental drivers are stronger than ever. According to his technical analysis, we're in the early stages of this transformation, not the late stages. The roadmap has been laid out, the timeline provided, and real-time market behavior confirms it daily. What you do with this information will determine whether you look back in 6 months with satisfaction or regret. Choose wisely.